All right. I just want to say welcome everyone to today's webinar, hosted, of course, by us over here at Headway Capital Private Equity Investments. Today, we're going to be discussing preparing for 2024 distressed real estate as a passive investor. We're really excited to talk about this topic, particularly because we've been getting a lot of questions as the calendar year turned. We've had a lot of our investor network reach out to us and say, hey, I'm looking to get back into real estate in 2024, or I'm finally ready to take the leap. I'm ready to make an investment into commercial real estate as a passive investor. What do I need to be doing this year to prepare for opportunities? And as we've alluded to and mentioned in other webinars, we believe there's going to be some distressed real estate opportunities in 2024. So we're going to spend today talking about how you, as a passive investor, can prepare to invest in distressed real estate. So let's dive right in. Uh, just a quick housekeeping things. If you want these slides, you like what you see on these slides as we're going through the presentation, shoot us a text 281-559-7061. Just text me, pay like the slides from tonight's webinar, preparing for 2024 distressed real estate. Make sure you put the title of the webinar in there so I can make sure I send you the right ones. We're happy to send you over these slides. You can also send me an email for them, brian@headwaycapital.us. Some other quick housekeeping materials. Quick disclaimer, this webinar is for educational purposes only and should not be considered legal, accounting, or investment advice. We are not offering or soliciting any solicitations here for investments or securities. Please consult with your own attorney, financial advisor, and CPA for legal matters, investments, and specific tax questions. Tonight's webinar is for educational purposes only. A little bit about Headway. There are quite a number of people on here, and I see some very familiar names. I also see some new people on here, so excited to say hello to everybody. Just a quick rundown on who we are over here at Headway Capital. Our firm is a Houston, Texas-based firm, and we were designed to build and protect the wealth of busy professionals. So our goal is to provide investment opportunities that give you the freedom to do what matters most. And our team has extensive experience sourcing, vetting, investing in alternative investments through multiple cycles. So we are a commercial real estate, private real estate investment firm. We're based here in Houston, Texas. We were founded by Sid Shamim and his wife, Anam Omer, in 2018. Sid was an oil and gas professional. Him and Anam were able to accumulate a pretty sizable residential real estate portfolio and decided they had enough of residential real estate and wanted to truly grow and protect their wealth that they were building, and transitioned over to commercial real estate and started Headway Capital Investments and Headway Properties. We are a vertically integrated commercial real estate firm. We manage our own assets that we own and operate here in Houston, Texas, which is a little over 13, right under 1,300 units here in Houston. So Sid is still our founder and CEO, very active, very engaged in our day-to-day operations, both on the capital side and then, of course, on the operational side, on the property management side, because we need to make sure we take care of our residents and that we take care of the property so that we can ultimately provide the returns that we promise to our investors. My name is Brian. I'm the Director of Investor Relations here at Headway Capital. And so I talk to all of our amazing investors and all of our prospective investors as well. Anybody who's interested in partnering with us over at Headway, whether you're a limited partner, just a passive accredited investor, if you have a fund, if you're a fund manager, if you're looking to do a 1031 exchange, if you are on the equity side, you're going to talk to me and you're going to talk to Sid. So I talk to all our investors and make sure they get that white glove service. And then finally, last but not least, we have Mr. Omar Nakvi. He is our CFO. We are excited for him to join our firm a little less than a year ago, but Omar has extensive experience in the commercial real estate space with an exclusive focus on multifamily operations. He brings a wealth of knowledge, not only on the financial side, but he's very, very savvy on the operational side too, and knows exactly what levers we need to pull to really squeeze a little juice out of the lemon so that we can provide better returns for our investors. We have a little over $500 million of assets under management here over at Headway, which equates to a little over 3,000 apartment units. We also have some car washes in there as well that we have an exclusive partnership with. And our number one goal is to provide our investors returns. Our goal is to provide you with a 20 to 25% on the low side, but we really target that 25 to 30% average annualized return. So our goal is to double our investors' money in 3 to 5 years. Of course, depending on market conditions, we could sell sooner and provide that return earlier, or if the market isn't doing so hot and it's time to hold the property longer, of course, we could ride the full length of the market cycle and go 5 years on our investments. And we currently have over 400 active investing partners. How do we produce these results over at Headway? How do we provide returns to our investors? How do we make sure our residents and our customers are well taken care of? Well, we stay really, really focused on what we're good at. We don't get shiny object syndrome and work on things that don't add value to us over here at Headway and ultimately add value to our investors. We're purposeful with every dollar that gets spent out our property. We really do deep due diligence before we decide to spend any money on the property and make sure that every dollar we put in puts $2 out. We want to make sure we're getting a return on our investment, and we're disciplined in our approach as well. So if we do this over a long period of time and we're consistent, we believe this is what is going to continue to create results both for our investors and our residents over at Headway Properties and, of course, at Headway Capital. So let's dive right in. You guys aren't here to hear about me, and you guys are here to learn, which is awesome. We love educating our investors and making them savvy so they can really understand what's going on in the market, so they can be a smarter investor and they can make wiser decisions when they decide to invest. So let's talk about our topic for tonight: preparing for 2024 distressed real estate as a passive investor. The first thing I want to do is I want to talk a little bit about the commercial real estate market. And I also want to talk a little bit about the multifamily market. So you can see here on this slide, this is from Marcus and Millichap, and it's pretty updated. It came out at the very beginning of January, about 2 weeks ago. And what this chart generally shows is that U.S. commercial real estate activity essentially slowed in 2023. Depending on which chart you look at, you're going to see somewhere between 20 to 25% a decline in activity last year, which is a pretty big slump. And we're using this 2014 to 2019 as a baseline for that 20 to 25% decline because we believe those years were the most consistent years when you look at this chart. So you're seeing a 20+% decline, and that is not surprising considering what happened last year with interest rates. The Fed started raising interest rates in March of 2022. That obviously impacted 2023 drastically, and we saw a massive decline in transactional volume, not just in multifamily, but across all asset classes: office, retail, triple net. Anything that was commercial real estate labeled saw a massive decline in transactional volume. But we are very bullish. We anticipate that there's going to be some sort of recovery in 2024 in commercial real estate. Not necessarily to the point of 2021. I think that was a historic year. I'm not going to say we'll never touch that number again, but I think it's going to be quite some time before we have transactional volume like we'll see in 2021. But we should see the market sort of correcting itself to pre-pandemic levels. So looking at that baseline average of 2014 to 2019, we predict that we're going to fall somewhere close to that line, right? Commercial real estate transactions should pick back up, especially as interest rates stabilize. Volatility is what kills a lot of real estate deals, not necessarily the rates. It's really hard to buy a real estate project if you're not quite sure where the rates are going. So at this moment today, all the headlines and all the economists, they're calling for a soft landing next year. And we're going to see if that actually happens. But most of the forecasts that we're seeing coming out have a low percentage risk of a recession, low chance of a recession coming out next year, because inflation has slowed, even though reports from last print were a little higher than expected by a couple of basis points, or hundreds of a basis points, I should say. But inflation has declined since its peak in 2022, right? And we've seen steady job growth, whether you're looking at the job data or you're looking at consumer sentiment. We've seen the steady numbers in those areas. So we're predicting that we're going to see a little bit more transactional volume this year. And this scenario ideally involves with the soft landing, but we'll see. Things are still very early. It's January. If the Fed sees a rise in inflation, they could decide to honor their original message, which was higher for longer. That's the message we've all heard. The Fed will raise interest rates and keep them higher for longer. We don't believe we are expected to see further rate increases, but what we could see is a very healthy pause continuing throughout the year, meaning we might not see rate cuts till the end of the year, Q3, Q4, or they could even go to 2025. Regardless of that situation, we think that the market will still pick back up on the commercial real estate side because the rates are stable. As long as rates aren't going up and there's a little bit of predictability and your ability to forecast what your cost of debt will be, that's going to help transactional volume quite a bit. And there's also a bunch of deals coming to market that were bought in 2019 and their 5-year business plan is over in 2024. And there were also some deals that were bought in 2020 and 2021 that had 2 and 3-year debt on it that are in a position where they either need to refinance, which is really challenging to do right now, or they need to sell. And if they get in a situation where they actually need to sell, again, that could create distressed real estate. And it could put us in a situation where there's a lot of buyers on the market who need to sell, but not necessarily want to sell. So that's why we believe that, at least on the multifamily side, we're going to see an uptick in transactional volume. You're going to start to see more deal flow come out this year, which is something we're excited about. Some other numbers here that I think are really interesting, talking more about the multifamily market. This is a little bit more detailed when it comes to multifamily versus commercial real estate in general. These numbers and these graphics you see on here are from CBRE, which is a big commercial real estate brokerage here in the United States. They also do some international stuff. They also provide a capital markets team, so they can provide you with debt and equity sources as well. But they're really brokers. They help transact deals both on the sell and the buy side for investors. These charts are really interesting. So the one on the left you see, well, before I jump into that, the headline for these two charts is the biggest wave of new apartment supply in decades will temper rent growth and improve affordability for renters in 2024. So this is really important to know as we get into the nuts and bolts of this presentation, because we have a lot of things going on in the market that could potentially improve affordability for renters, and that means that we are going to see rent growth soften in 2024, which isn't necessarily a bad thing. It's just something you need to be aware of. So let's talk a little bit more about that and peel back that onion. So figure 15 here on the left, you see the forecast for multifamily vacancy rates versus pre-pandemic averages. And you see a chart here. So at the bottom, we have some cities, some major some major metros. And then on the left-hand side, on the y-axis, you're going to see our vacancy rates. So you'll see we are based in Houston. We're a Houston-based commercial real estate firm. That Houston is expected to see a 7+% vacancy rate in 2024 compared to the national average from 2015 to 2019, which is a little bit below 7% in the mid-high sixes. Why is this happening? Why is Houston and some of these other major metros projected to see a slightly higher vacancy rate? Well, this has to do with the amount of deliveries that are coming online in 2024. And what do I mean by deliveries? Deliveries are the number of new construction multifamily units that are expected to hit the market in 2024. A lot of projects got started coming out of 2021 and 2022. If you look here on the right-hand chart, figure 16, Q4 2021, all the way into mid-Q 2022, you'll see on the left-hand side on the y-axis the thousands of units, and on the bottom on the x-axis is the year. You'll see that a lot of multifamily construction starts peaked mid-2022. Well, if construction starts on an asset mid-2022, and these projects typically take 1.5 to 2 years to go on to actually be delivered to market, where tenants can actually move in and start renting them, when are they coming to market? The answer is now. So there's expected to be 440,000 new units being delivered this year, and there's 900,000 current units under construction. So combined between new deliveries and assets under construction, there's over 1.3 million units being delivered in the next 12 months. Well, that's when there's new units hitting the market, that's going to affect supply and demand, right? So once you have a massive intake of supply, there's a lot of supply and demand isn't there for it. What does that do to anything? It pushes down pricing a little bit, right? So while we're not expecting to see major rents decline, we didn't expect to see a 3, 4, 5% decline in rents. What it's going to be more challenging to do is it's going to be challenging to see what we call organic rent growth. Organic rent growth means natural rent growth without forced appreciation, or forced value add strategy. So you've got forced rent growth and organic rent growth. Forced rent growth is going to be from renovating units, doing granite countertops, replacing flooring, new painting, anything cosmetic. That's forced rent growth, meaning I am improving the property and therefore it is more expensive to live in. We're raising rents. Then there's organic rent growth. That is rent growth that is just happening organically because it's a market that is desirable to live in. People are moving, people are thriving there, job growth is happening, and consumers are naturally paying a little bit more for the unit. So we expect to see a flat organic rent growth throughout 2024. We'll talk a little bit more about why this is important when you're considering investing. But kind of overall, big picture, CBRE put out a report saying that they expect weaker than average rent growth in the 1.2% range for 2024. And Freddie Mac, which is a government subsidized, provides lending services to banks and for lending for multifamily debt. They predict it to be around 2.1%. So somewhere between that 1 to 2% is where most forecasts and most economists are predicting rent growth to be in 2024. And that is a result of a massive amount of supply hitting the market. We talked about 400,000 new units being delivered and another 900,000 units being delivered between this year and next year. So 1.3 million units total. That's going to overall slow down their ability to push rents on the organic side, right? So that's also going to impact not only rents, but it's also going to impact a vacancy. So when there's new units online, there's a lot of new apartment units. What is going to happen? You're going to have natural upticks in vacancy, right? So on the left-hand side, that's why you see Houston, San Antonio, Phoenix, Dallas, Austin, Orlando. These are markets that have a lot of new construction properties coming online. Well, that's going to push down rents a little bit, and it's also going to raise vacancy. So there's going to be more units that do not have renters in it because now there are more supply online. So supply is expected to slightly outpace demand, which is going to increase your overall vacancy rates, at least forecasted for 2024. So just something to keep in mind as we go through the investment and we kind of again go back to the nuts and bolts here that there's expected to be an increase in supply. There's a lot of new units coming online. That's going to impact the ability for organic rent growth. It's also going to impact the ability for us to keep vacancy rates really low. Again, it just means that you have to work a little bit harder to get what you want out of these properties. With that being said, it is really important to know that that same organization that provides that lending policies for multifamily lenders, Freddie Mac, they are predicting that we will still see an uptick in volume. So you'll see here, we did about 285 billion in multifamily real estate. Freddie Mac calculated those numbers in 2023. Well, they're predicting 370 to 380 billion in 2024. That's a little bit over $100 billion of additional multifamily transactions happening, right? So that's a lot. There's going to definitely be an uptick in demand. There's going to be for investments, I should say. People are going to be looking to transact in multifamily, and we'll talk a little bit about dry powder on the sideline and people that have investment capital, but there's a lot of stuff going on here when it comes to multifamily. A little bit more details, talking a little bit about the probability of federal rate cuts and why we believe that we're going to see this uptick in demand is right now, Wall Street is forecasting the numbers that you see on your screen. So they're predicting there's a 60% chance that the Fed reduces rates to the 5.25 point by March. There's a 50% chance that they reduce those rates to 4.5 to 4.75 by June, an 80% chance that they reduce those rates by 4.25 to 4.5, and an 85% chance that the Fed reduces rates to sub 4.25% by December 2024. Now, these numbers move pretty frequently. They change almost daily if you actually look at them. Regardless of that, whether these numbers are 50% or 60% or 80%, the market is forecasting that there will be some sort of rate cut sometime this year. The question becomes more not necessarily if, but when, right? And when rates do get cut, whether they're 25 basis points, 50 basis points, 75 basis points, 100 basis points, that's going to be a green light to a lot of investment organizations, especially these big institutional people, life cos, private equity groups that have hundreds of millions of dollars, if not trillions of dollars, billions of dollars to invest. They're going to be looking to slowly start dipping their toe in the water and getting back into the commercial real estate market as we see price corrections, right? We've already seen price corrections. So they're going to be licking their chops at some of this distressed or discounted real estate. And as I alluded to, there's a lot of pent-up capital. It's near an all-time high. So again, this chart here from Marcus and Millichap, I think is very, very interesting. Not quite 2022 high, but there's about $240 billion of dry capital, pent-up capital sitting on the sidelines looking for a place to invest, according to Marcus and Millichap, the commercial real estate firm we talked about. So there's a lot of dry powder on the sidelines. There's a lot of institutional capital. There's a lot of life cos. There's a lot of family offices. There's a lot of people sitting on the sidelines that have been sitting on the sidelines for the last 12 to 18 months that are looking to deploy capital. And they're not going to only deploy capital in the multifamily space or in the commercial real estate space, but it's definitely a big part of their portfolio. So as we talked about adding close to $100 billion of commercial real estate transactions, those are going to start to happen because of all this pent-up capital. They're going to start to happen because of the distress that we predict might hit the market due to, as I mentioned earlier, some buyers overpaying for stuff. They need to refinance or sell by 2024, and they're not able to do so. So there's going to be some assets hitting the markets that are either bank owned potentially, or that are just sellers that absolutely have to sell either for a loss, or at a break-even point where maybe they held the property and the investors didn't make a ton of money, right? So we believe that all these signs are pointing to an uptick in the multifamily and commercial real estate market for 2024. And why are we still bullish on multifamily? Well, I just want to give you one piece of data that I know we've been talking a lot of great reasons here, but one piece of data that I think is really, really important to look at, and that is the gap between the ability for the average person to own versus rent. So this chart is really quite telling. And I'll start by looking at starting from the bottom, kind of working my way up. But if you look at the 2022 and 2023, what you'll see here on the left is the mortgage rates, right? So obviously, mortgage rates dropped to about 2.67 on Q4 2020. That's about as low as they got as a nation average. And once they started cutting rates that low, you'll see there was a massive swing in the median sales price of homes, right? So they went from about high twos as the median sale price going into COVID, all the way down to the high threes at the end of 2020, Q3 2023. And what happened to the interest rates? They went up, of course. But look at these monthly principal and interest payments. So principal and interest, remember PI, it doesn't these numbers do not include TI, which is taxes and insurance. So right now, as of this data was last updated, was Q3 2023. The monthly principal and interest payment for a median home price in the US, that's 393,000, is right under $2,200. Now, once you include taxes and once you include insurance, it depends on the market you're in. Of course, some properties in certain markets have much higher taxes and insurance, like Texas. In Texas, you're adding hundreds of dollars to this number. So once you include taxes and insurance, this 2162 is probably closer to 2600. Look at the average multifamily monthly rental rate. Now, while rents have grown, they went from 1439 in Q1 2020 all the way to 1824 in Q3 2023, which accumulates to a 20% increase in rents. Think about that spread gap. You're paying $1,800 a month on average, according to the US, for an apartment versus spending $2,500 or $2,600 for a almost $400,000 home. That $700 might not seem like a really big difference, but it really is, especially in more blue collar markets like Houston, like San Antonio, that have more blue collar workers. The average person just cannot afford to pay $2,500, $2,600 or more for a $300,000+ starter home. Looking at today's interest rates now, they're not quite as high. The rates have dropped a little bit. I think they're in the high sixes last time I checked for a residential mortgage. But still, that's going to put the average rent still around the $2,300, $2,400 a month once you include taxes and insurance. As I mentioned, the average rental rate is $1,800, right? So there's a massive gap between what people can afford on the renting side and buying side. Owning a home just is really, really hard for a lot of people that are in a situation. So there's an argument to be made that we're becoming a nation of renters by necessity versus becoming a nation of renters by choice, right? So for owners and operators of commercial real estate, particularly in the multifamily space, this is a great thing that homes are still really expensive. And my personal opinion is if they continue to if they start cutting rates, which we talked about, we're not sure when, it's more not necessarily if, but when, that's going to lead to an uptick in demand in the residential market. I personally don't see the residential real estate market softening much more than it does on the price side. Of course, it could happen. There would have to be some pretty drastic economic indicators that would show you that, such as job unemployment, because right now, there's a very large amount of people that have a sub 5% mortgage. They refinanced when rates were as low as 2.67% in this high twos, low threes, or they bought around this time in the high twos and low threes, and they don't have a lot of motivation to move or refinance, right? So in the situation that we're talking about, there's just there's not a lot of reason for pricing to drop unless there's a lot of unemployment, right? And right now, unemployment is still sub 4%. It's exactly where the Fed wants it to be. So people can still afford to pay their mortgage. So as long as people can pay their mortgage, it doesn't really matter what rates are at today because so many Americans have a sub 5% mortgage. I believe it's over 60% of mortgages that are out right now are sub 5%. So there's not really a lot of reason for single family housing prices to drop. But if we got a big recession and a lot of job losses happen, which would lead to a lot of unemployment, which would lead to people's inability to pay their mortgage, you could see, of course, a softening in the residential real estate market prices. But right now, the economic data isn't showing necessarily that there is they believe there's a soft landing coming, whether you believe it or not. So the data that they're showing, that they're saying, is that we've sort of gone through the worst part of it. The soft landing should be happening. And if that does happen and unemployment does stay low, like they anticipated does, sub 4%, which is their goal, there shouldn't be a reason for prices to drop, which is great for multifamily because even though we don't predict a lot of higher rent growth, at least for 2024, rents are still drastically far apart from what it costs to buy a home, which is good news for us. So how do you prepare for this, right? How do you prepare for the opportunity to invest in these types of assets, to invest in distressed multifamily? We talked a little bit about transactional volume picking up this year due to distressed owners, right? We talked a distressed owner. We'll go into this here in a second, and what the definition of a distressed owner is. But how do you prepare for this? How do you get ready? So first thing you want to do is you want to make sure that you are setting your goals now, right? So you want to make sure that you are preparing. Ask yourself questions like, how much capital are you looking to place in 24? Are you looking to place 50,000, 100,000, 250,000, half a million, whatever your number is? Set those goals now and be disciplined about how much capital are you planning to invest in 2024. So set a number in your head so that as you're looking for deals, that you're looking to deploy capital. You have a number in mind, right? You don't want to not going to the year knowing how much capital you're looking to deploy, because that's not going to help you reach your financial goals. If you know this year I'm looking to invest in 2 multifamily deals, I'm going to put $100,000 in each one. I'm looking for at least X% return. Set those financial goals for yourself, right? Are you looking for cash flow or are you looking for equity? Right now, in my opinion, I think all investors should be looking for cash flow, even though they might not need the cash flow if they have a great job, because cash flow provides a little bit of a security net. We'll talk about that here in a second. Or are you looking for more equity plays, right? Are you worried more about upside and what the exit looks like versus the cash flow? But set those goals for yourself. For me, if I'm looking to invest in 2024, I'm focusing on properties that have a true value add component. Why am I focused on true value add? Well, that's because, in my opinion, we don't know what's going to happen with the economy. The Fed is saying soft landing, but what happens if they're completely wrong? What happens if we do go into a recession? What happens if we do go into some sort of tough economic cycle? I personally want to be invested in a property where I have the ability to do a value add strategy, improve the property, and force that appreciation no matter what's going on in the market, right? If you invest in, say, an A-class property and the market, the economy doesn't do very well, it's going to be hard to squeeze any juice out of that lemon, because people that live in A-class properties often get affected just as hard as blue-collar people, because they have white-collar jobs and there's a lot of layoffs happening. And you don't have a value-add strategy in that situation, because it's a newer property. You're not able to renovate the units. You're not able to push the rent growth as much. It's a little bit harder to squeeze any juice out of the lemon because there's not a lot of value-add component. If you invest in, say, a C plus property or a B minus property, a solid B class 1980s, 1990s property, that has some upside potential from cosmetic renovation, operational renovations, then you actually have a true value add component there. No matter what's going on in the market, you can still go and renovate units. When you renovate units, you can still increase your rents. And when you're increasing rents, you're improving your NOI. When you're improving your NOI, you're improving the value of the property, which is ultimately what you want as a safety net as a passive investor. So for me, the other thing I'm looking for is cash flow year one, important in case the market conditions change. There's a lot of deals that have came out in the last, say, 2-3 years that don't have a really strong cash flow, especially year one. For me personally, I'm looking for properties that are producing cash flow year one as a safety net, because if you don't have a lot of cash flow going into a property, and again, the market conditions change and the economy changes, that could really impact your ability to cover debt service, which, basically your ability to pay your mortgage. It can also impact your ability just to execute your business plan, right? So that cash flow year one is really, really important. Second to the last thing on here is get your cash ready or your self-directed IRA ready. So, as a private real estate firm, there's a lot of ways to invest with us and other firms like us. One is cash. Of course, if you have cash in the bank, we take it gladly all day. But another option is a lot of investors like to use a self-directed IRA or a 401k. To invest in these properties. Well, it's best you get ready by creating that account with a custodian. And I'm happy to make connections there if you're looking to transfer funds over from an IRA or 401k. We can help you there as well. But you want to get those funds ready to invest. And last but not least, a little plug here: sign up for our private investor club, which we'll talk about towards the end. You want to be on our investor list so that when these opportunities come in 2024, you see them, you get first access to them, and of course, you get the opportunity to invest in them. What about evaluating these deals, right? When let's say you're prepared, you've got your money set aside, you signed up for our passive investing group, you know what you're looking for, you're looking for cash flow, you're ready to go, you're ready to rock and roll. You just need to know, you just need to see deals and you need to know how to evaluate them. Well, let's talk about evaluating a distressed investment opportunity, and let's talk about what qualifies as a distressed investment. So first of all, a distressed investment is something that is distressed either operationally, financially, or cosmetically, right? Those are three really the main buckets I like to think about distress. So, operational distress is basically an asset that is being very, very, very poorly managed. There's bad property manager on site, whether it's the leasing manager, the leasing assistant, maintenance crew, or just a bad company that's managing it. That's operational distress, meaning the residents are getting really poor service, and that's causing distress, their inability to push rents and really maximize the property's performance. That's operational distress. The second part would be financial distress. And there's a lot of different types of financial distress, but the number one you'll probably see this year is properties that can't afford their mortgage because they are in a situation where maybe they bought a property in 2020, 2021, 2022. They have a floating rate interest rate debt. Whether they have a cap or not can sometimes impact their ability to pay the mortgage. But either way, their property is getting squeezed by the debt payment. They can no longer afford the mortgage, so they're in financial distress. And sometimes, I've seen before too, it may not even be the debt service. It actually might be things like taxes and insurance. Taxes and insurance in markets like Florida, markets like Texas have just devastated multifamily performance over the last couple of years. We've had some properties, seen some property quotes that go up 30-40% a year for things like insurance, taxes that double. So there's just really interesting situations that have happened, things that are unfortunately out of the operator's control, and they didn't do anything wrong. We had some catastrophic events that happened in Texas. We had the Great Freeze of 2021. That was the largest insurance loss run in the history of insurance. Taxes have been really aggressively reassessed by state and county departments here in Texas. So these are things that nobody really saw coming. And if you layer on top of the fact that your debt service has also increased, if you're on a floating rate loan, some of these properties are financially distressed. They can't afford their mortgage. So we talked about operation, we talked about financially, and the other one's cosmetically. And those are usually the pretty easy ones to tell. They're the properties that just need a lot of love. They've got really old appliances, really old countertops. They haven't been renovated in years. They're usually long-term owners that have owned for 10, 20, 30 years. Those are the properties that may be cosmetically distressed. They really need some love, and most of the time they need a mix. It's usually a mix of operational and cosmetic distress. But sometimes, you see deals that are performing really well operationally. They're cosmetically awesome, but they're in financial distress. And I think you'll see a lot of that in 2024. So what do you want to watch out for when you're looking at these deals? If we're sending you deals, or if other investors or operators are sending you deals, what do you really want to look for? These are the things that I think are most important going into this year. Some of these are on here all the time, but I want to highlight some important conversational pieces about this year in particular. So one is location. I think location is really, really crucial for this year because I personally would not want to be investing in a market that may be going through a recession if we do have turn the corner and go the wrong direction. That's in a tertiary market, a market that no one's ever heard of, because those are the markets that typically recover the slowest, right? So if you're investing in a major market, a Houston, a Dallas, Austin, San Antonio, Atlanta, Orlando, these are big, big, big major markets with millions of residents. These markets recover faster. So even if you go in an investment and it doesn't necessarily, maybe year one's not as great as you thought it would be, and the market kind of turns, they're going to recover much faster because they're in strong major metros. So location is really important. I would encourage you to focus on investing in major metros and the suburbs of those major metros. Stay out of the tertiary markets that are in places that nobody's ever heard of. Yeah, the prices might be great on these properties. You might see severe discounts. But you have to be really careful because when you try to sell, especially if the market's not in a great place, you might not be able to get what you think you can get for it. So location is really, really important. The second thing is, what asset class is it, right? So we're talking about multifamily here, but is it an A class property? Is it a B class property, or just C class? Well, the difference in those asset classes really has to do with vintage. When was it built? It was vintage, and then really the amenities. What type of amenities does it provide? And then the third thing is really, who does it appeal to demographically speaking? What type of residents are on the property? So your A-class properties are typically going to be in core, inside the major metros, the cities. They're typically newer construction, thinking probably 2015 on up. So 7 years or less, 7 to 10 years or less in age. They typically have all the bells and whistles, the pools, the gyms, the clubhouse, just more fixtures and stuff in the apartment that are a little bit smart thermostats, smart locks, smart garage keys, pet washing stations, EV car chargers, really A-class amenities, right? That A-class residents expect, and they're usually in nicer areas, right? So these are A-class properties. B-class properties are going to be a little older in vintage. They're going to be really solid, really stable properties, great bones, typically 1980s to 2000s construction. Still have a lot of amenities, but maybe a little outdated, and it could be ready for a first or well, probably a second or third generation of a value add of improvements, right? But still in really solid areas. We like to say they're affordable apartments that are in great areas. So they're still in good school districts. They're in good areas. And then the last one is C class properties. So these are going to be your more affordable housing type place. These are going to be properties probably built prior to 1980, 1960s to 1980. They're going to be older. They're not necessarily going to have all the same amenities. And if they do, they're a little bit dated. And then really the big piece of this one too is that they appeal to more affordable housing clients. So these are going to be more your blue collar workers. These are going to be your restaurant workers. These are going to be your retail workers. These are people that aren't necessarily as concerned about amenities and luxury. They just want an affordable, clean place to live. So for me, this year alone, I am personally with my own investment capital, and what we're doing here at Headway 2 aligns really well with it. I want to invest in the B class and the C class properties because, as I mentioned on the other slide here previously, focus on properties that have a true value add component. Well, it's really hard to find those true value add components in the A class space. They do exist, but they're much harder to find, especially if you find something that's right on the cusp of, say, like a B plus asset, A minus type asset. Those are still good. But most of the A class stuff, they're so new and they have so many amenities already. It's really hard to add a lot of value and to improve the rents there, right? So I like to focus on the B and C class properties, especially if we're in kind of a rocky market, because you know you're going to be able to go in there and renovate the units, renovate the amenities, improve the property no matter what. And that means you're going to be able to increase the rents no matter what, right? So really, really important as that safety net that you're investing in assets that have a true value add component. The other question you're going to want to ask is who previously owned and operated this property, right? So if you're investing in a property, you want to know who had it before you and why is it distressed. If it's a distressed property and it's been made very clear by the new buyer, let's say if we're buying something and we say, hey, this is a distressed asset, you want to ask questions like who previously owned and operated. Was it somebody who was a quality owner? Was it somebody who was a quality operator? It's really important to kind of get the story about why is it distressed, right? Was it debt? Was it operations? Is it cosmetic? One of the three options I just mentioned earlier. It's really important that you ask these questions because you want to make sure that the sponsor or that the operator, the group that's sending this investment to you, that they have a business plan around getting it out of that distress situation, right? So really, really important you ask these questions. The other one on here that maybe kind of an unfamiliar term for people is the entry cap versus the exit cap rate. So commercial real estate are valued on cap rates. So unlike residential real estate, which are valued on comps, we value our properties based on cap rates. The properties are valued on NOI divided by the market cap rate. Now, the market cap rate in different metros varies drastically. Houston right now is about a six and a quarter cap, maybe a 6.5 cap market, which is much has went up substantially over the last 18 to 24 months. But what is the entry cap rate? What are we buying that property? What cap rate are we buying it at, right? And then what is the exit cap rate? So you want to see the spread between the entry cap and the exit cap. And this is sort of a safety metric because if we're buying a property, say at a 6 cap, and then we plan on selling it at a 6 cap, there's a debate to be made whether that's conservative or it's aggressive, right? If we plan on selling it at a lower cap rate, that would be considered aggressive, right? So buying it at a 6, selling it at a 5.5, that's considered aggressive. That means that we believe that we are going to see cap rates compress and the market's going to actually improve. Going the other way around, if you say we buy it at a 6 and we're planning on selling it at a 6.5 or higher, you've got a 50 basis point spread. That would be considered a more conservative approach. You're assuming that the cap rates actually go a little higher and actually go the other direction. So it's just a question to ask on how the property is being valued on the exit. Is it being valued using the same cap rate that it's being bought at? Is it being valued at a lower cap rate? Is it being valued at a higher cap rate? And for me personally, I like to see my investments with some sort of spread. I like to see at least a 50 to a 75 point base spread on the entry versus the exit. I want it to be 50 to 75 basis points higher on the exit. At the very least, I want to see it flat. I don't want to see, a cap rate going in the other direction. The next third from the last thing here is, does it cash flow year one? I've kind of beat this horse dead already, but I think it's really important this year when you're evaluating distressed real estate that you get some sort of cash flow year one. Investors are a little nervous right now when they're investing in real estate compared to 2 years ago where everybody was super excited to invest. Investors want cash flow, regardless of whether they need the cash flow. You might have a great job. Lots of our investors make $300,000, $400,000, $500,000 a year, and they don't need the 7 or 8% return that they might get from cash flow year one. But the cash flow is a peace of mind type of thing. It shows you that you're making an investment that is paying off, which is psychologically really important for you as an investor. And then ultimately, if a property is cash flowing to year one, that means that it's got some sort of safety net, right? If things don't go as planned, if operations don't go as planned, if the economy goes in the wrong direction and we go into recession, there's some cash flow there to save you so that you can continue to pay your mortgage. So that's really important to see going into year one. Is there a value add play? Again, we talked about this. You want to see some sort of ability to add value through renovations, operational improvements, raising rents, improving amenities, things of that nature. And then what are the last thing on here that we haven't talked about a lot today is, what are the rent growth assumptions? I talked earlier about how most of these large commercial real estate firms like Freddie Mac, Fannie Mae, and Marcus and Millichap, CBRE, they're predicting a 1 to 2% organic rent growth in year 2024. So that's organic. Now, if you're forcing rent growth, let's say we're renovating, we're putting $7, $8, $9, $10,000 worth of improvements inside of each unit, meaning we're doing all new flooring, all new paint, all new countertops, all new appliances, changing out the doorknobs, changing out the handles, making the property beautiful. We're spending $8,000 to $10,000 per unit doing that. That's forced rent growth. That's different than the organic rent growth. The question you want to ask when you're investing in these projects is, let's say, for example, you see year one, let's say you see a 3% rent growth. Well, the question then becomes is how much of that is organic and how much of that is through improvements, right? Forced rent growth. So really important that you ask questions about the rent growth assumptions. You want to make sure that the operator is not assuming that the rent growth is going to improve simply because the market is going to improve. We've already talked about how unsure we are of the market. As an economy, they're not quite sure if we're going to hit that soft landing, right? And the forecast is from a 1 to 2% rent growth this year. Well, you want to make sure you're asking the operator if you see a 3% or a 4% rent growth. Tell me about your rent growth assumptions. How did you get to that number? Is that organic or is it through forced rent growth, right? So really, really important to know before you invest in a deal. Oop, a little too fast there, excuse me. The next slide talks a little bit about risks involved, right? So we like being transparent here at Headway. It's not all rainbows and investments and every deal starts paying cash immediately and everything's great, right? There's risks involved with these deals. We like to make sure everybody also understands that risks that are involved with investing this year, right? So what type of risks are involved in 2024? So one of the risks is the Fed holds interest rates too long and leads to a recession, right? We talked about this already today. But if we get into some sort of situation where the Fed decides, you know what, we said we were going to cut rates this year, we changed our mind. We're not going to cut rates this year. We're going to wait till 2025. Well, the Fed could do that. And if they do decide to do that, they could end up keeping the rates high for too long, which actually could cause a recession. And what happens if we get into a recession? One, it could be harder to achieve your rent growth goals, right? Which is why we talked about having that value add play. The value add play is a safety net, being able to push rents no matter if we're in a recession or not, because we're improving the units. It's a nicer place to live. It's a nicer community. The second thing is, if we go into a recession, it could be slightly harder to collect rent. During recessions, people have trouble paying the rent, especially if you're in a C-class property. People lose their jobs, they make less money. So it could get slightly harder to collect rent, which is just something really important to know. Not to the point where the property falls apart and collapses, but it could get a little bit trickier to collect rent. And it's really important that you work with a strong operator that knows how to collect that rent even during tough times. And then the last thing is if the Fed holds that interest rate for too long and you buy in 2024, of course you could miss your Q1, I'm sorry, not Q1, year one pro forma, right? So if things aren't as rosy as the Fed predicts they are and as the market's predicting they are, you could miss your pro forma potentially with rent growth and unit renovations and things of that nature, which isn't always the end of the world. Doesn't mean it's a bad investment. It just means that 1 out of the 5 years you plan on investing might not hit its goals, right? The other risks involved with 2024 are high interest rates on fixed debt, right? So everybody thinks floating rate debt is bad, which in my opinion, it's not. I still like floating rate debt a lot. I'm still bullish on it. But the problem right now with floating rate debt is interest rate caps are really expensive. So buying the cap so that the interest rate doesn't go above a certain level, they're really high, 7 figures high potentially. Most of the time, high sixes. So you're looking at anywhere from $500,000 to $750,000 for interest rate cap to prevent it from going higher if you use floating rate debt. But on the fixed rate debt side, the risk involved with buying a property with fixed rate debt, if you're thinking like, oh, you should always be buying deals with fixed rate debt so you don't have to worry about the mortgage. Well, that is a pro, but there's also a con to buying things with fixed rate debt, especially when you're at the top of the market. Investing in a property with fixed rate debt when interest rates are at the top of the market means you stay at the top of the market throughout the life cycle of the deal. Well, why is that a problem if the property's cash flowing? Well, it's a problem if you decide you want to exit early. So in commercial real estate, most of the lenders have what's called a prepayment penalty if you exit the loan before the loan is due. So most of these loans are for 10 years, right, on a fixed rate loan. And if you, let's say you exit the property in year 3, if you exit the property in year 4, if you exit the property in year 2, let's say the market actually is amazing in 2 years or in 3 years, and you want to sell early and take advantage of all the market going in the right direction, going up, and you're able to get your returns, and we're able to get the IRR and the average annualized return that we promised our investors early. Well, that's awesome. I want to sell in 2 years or 3 years and return our investors' capital early if we can. But what's the problem with that? Well, the problem is if we have fixed rate debt, we might get caught with a prepayment penalty. These are step down yield maintenance or defeasance type payments, where basically the lender says, hey, Headway, you guys said you were going to borrow this money for X number of years. You're not living up to your side of it. You're selling early. Well, we're going to charge you a penalty for selling early. And I will tell you, I have had many conversations with many other real estate investors that sold properties early on fixed rate debt, and they have gotten hit with very hefty prepayment penalties, sometimes 7 figures, right? So there could be a situation where we want to sell early, we can sell early, but we might have to leave hundreds of thousands of dollars, if not millions, over $1 million of money on the table and give it back to the lender because we did not honor our original debt terms and keep the debt note for as long as we said we were, right? So that's something to be considered of, and that is only the case usually in long-term fixed rate debt. So again, something to keep in mind, not pros or cons, but there's always pros and cons of fixed rate and floating rate debt. And then the last risk involved with this year is investing with the wrong operators or deals. I would highly recommend you focus on strong operating experience, people with strong operating experience, just because right now we're in very uncertain times. If the market stays where it's at, you're going to want to invest with strong operators because there's a lot of properties that are distressed both operationally and financially right now. And if the market gets in a tougher situation, let's say the economy does fall into a recession, you want to be invested with people that have a lot of experience working through tough times. We've been through COVID. Most of our assets when we first started Headway were C-class properties, properties that really needed to be cleaned up. So we have a lot of experience collecting rent, improving properties that are tough, and especially during tough times like COVID. So it's important that you operate with people that are experienced operators. And as I mentioned, we are owner operators in the sense that we own our own property management firm. So we have a little bit more control and speed of control doing things in-house versus paying a third party and having to go through the hierarchy to get things done. We want something done, we could do it quickly. Really, really, really great benefit. So how do you mitigate some of these risks going into 2024 that we just talked about? One is I believe you should come into these deals having a long-term approach. These are 5-year investments typically. We always tell our investors to plan to hold for the whole 5 years, but you should really be thinking long-term. Just because one of the years, let's say maybe this year doesn't go as great because we fall into a recession, doesn't mean it was a bad investment. You have to think about these investments as a long-term approach. As long as you're investing with a strong operator, you have the right business plan, you're in the right location, and you're still bullish on the asset. You like the asset, it has potential, it has a great value add strategy, and you know the operator has the capability of pulling it off, is a long-term holds. it's going to be fine, right? It's going to be not as pretty as you maybe thought, where you can get in and out in 2 or 3 years. But it might take a little bit longer. So you should always plan to hold the property for the life cycle of the deal. Have a long-term approach when you think. The second thing that you can do to mitigate some risk is just diversify your investment. So always use cash flow as a safety net and invest in more than one property type, right? So we talked about A class, B class, C class. Try mixing up your portfolio a little bit. Invest in a B class property, then invest in a C class property. Invest in a car wash. Have some money into another short-term investment, whether you're invested in CDs, money market accounts. We have an income fund here at Headway. There's different things you can invest in that can provide some short-term liquid options that give you some cash flow, right? And then there's some more long-term plays. And when you're investing in the long-term plays, look to diversify your portfolio a little bit. Third thing, as I mentioned, invest with proven operators with a track record. And the fourth thing is to thoroughly review each investment. We talked about this already. Make sure you're asking lots of questions. Make sure you're thoroughly reviewing what you're getting into. It's really important that you have a very clear understanding of the asset, the business plan, and what the plan is throughout the life cycle of the deal, so that you can hold the sponsor accountable to achieving that business plan. And the next to last thing, or the last thing on here, is just stay updated with what's going on in the market. It's really important. All the stuff that I shared at the very beginning of this presentation about the economic data, we didn't talk a lot about GDP, but looking at GDP, looking at inflation numbers, CPI, core CPI, looking at unemployment, looking at rental rates, looking at which markets are doing well, looking at which markets have a lot of units coming online, looking at vacancy rates. These are things that are readily accessible online. You literally can just type in Google, multifamily forecasts, multifamily Houston report, different things like that. You're going to get lots of data points that tell you about how each market's going, right? So stay in tune with what's going on in the market so that you can be a smarter investor. Let's move on and talk a little bit. We're not going to talk about tax advantage tonight, so I'm going to skip that slide because we do want to wrap up. We got about 8 minutes left, and we do have some questions. So just quick final statement. As far as everything we talked about today, we're still bullish on 2024. We believe personally there's going to be some great investment opportunities this year. We are starting to see signs of good deals hitting the market. It's been a while since I've been able to say that. We've looked at several deals in the past few weeks. Just now it's early January. We've looked at several deals in the past few weeks that actually have strong cash flow year one, which I just kind of shocked my mind when I first saw them. Now, the problem, of course, is making sure that we are thoroughly reviewing, not problem, but what's important to us is to make sure that we're thoroughly reviewing these deals. There's a good story behind it. We understand why the seller's selling. These assets aren't always distressed. Sometimes they're just long-term holders, right? We've talked to some owners that have owned the property 10, 20, 30 years, and they're finally ready to exit. The property's not in trouble. They're just ready to sell, right? And sometimes when people need to sell, they need to sell. And the fact that prices have dropped, cap rates have went up, we are now able to see cash flow, which is a great thing for our investors and a great thing for us over here at Headway. So we're bullish on the market, regardless of whether there's a recession, not a recession, soft landing, hard landing. We're going to be looking to provide great investment opportunities. And you, as a savvy real estate investor, a savvy passive investor, you should be looking to place your capital with good, strong operators at all times. You should always keep your eyes peeled on what's going on in the market and be looking for investment opportunities. So with that being said, just to talk a little bit about what we do real quick before I jump into Q&A, the types of deals that we typically put in front of our investors are, one, we want to find multifamily apartments, oftentimes distressed, not always, but distressed multifamily deals. We do have our real estate income fund, which I'll talk about here in a second. And we are also always on the lookout for car washes. How can you get into these deals? One, you do need to be a part of our private investor club. So if you're not a part of this, I would highly encourage you to reach out to me. Sorry. If you're interested in gaining access to our club, a couple things you'll just need to do is one, submit an application on our website or reach out to me. You got to have a quick call with me just to clarify, make sure we're a good fit for you and you're a good fit for us. And then you must be an accredited investor, which just means you have to have a $1 million net worth, not including your primary residence, or you have to make at least $200,000 a year if single, $300,000 a year if married, 2 out of the last 3 years, and you plan on making the same type of income going forward, right? By joining the club, you'll gain access to our members-only in-person events. We do have a property tour scheduled in February, and we also are planning on hosting our first investor dinner of 2024. And these are for our private investor club members only. So if you want to get an invite to our dinner, these are very small, very intimate dinners. Typically, we're inviting anywhere from 8 to 12 people. just to come out, meet us, talk real estate, and of course, get to know you. We like to get to know all of our investor clients. You got to be a part of our preferred investor club, our private investor club. And then we have obviously our webinars that we do both for people for both new investors, experienced investors that are a part of our group, and then of course you get early access and exclusive access to our investment opportunities. These deals typically fill up pretty fast when we do have them. Usually, it just kind of depends on the market and size of the deal. We're seeing anywhere from 2 to 4 weeks. These deals typically fill up, so it's important that you get on our private investor club because you get early access to see it first and reserve your spot if you're interested. You can join the private investor club by scanning this QR code, or you can just reach out to me via email and say, "Hey, Brian, I'd like to get on the call and talk about joining the club." I'll just have a quick call with you. We'll go through some questions and make sure you're a good fit, and we'll get you on the list. It's no charge to be on the list. We just ask that you stay active and engaged, that when we have investment opportunities that you thoroughly review them and consider them for investment. Of course, you don't have to invest in every deal, but you should at least consider investing and take a good hard look at everything. And last but not least, I do want to mention our Headway Capital Income Fund. The way most of our investors get started with us here at Headway is they like to place a little bit of capital into our income fund. Typically, this is anywhere from 100 to 250,000. They put money into this income fund. It does earn up 8% preferred return, annualized return, excuse me, per year, and it's just a cash flow fund. We do this for our investors, and what they can do is once the money is in the income fund, is they can move money over to our equity deals if they see something they like. If not, they can leave it in the income fund, and it earns 8%. Annualized return. It pays cash flow. It pays distributions every month. There's no equity upside. The 8% is earned by we give out private loans to real estate investors with one of our investing partners, and we charge them a higher interest rate, typically 13 to 14%, and that 8% is earned on an arbitrage play. So this is a great opportunity. I like to consider it a high yield savings account. We have several hundred thousands of dollars in this in ourselves that we've put into it just in the last couple months into the income fund. It's a great way to earn 8%, no work, and it's securitized, backed by residential real estate. There's usually over 200 loans being active at any given point, so your money is spread out across a bunch of different loans. So that's a good ability to mitigate some risk as well. So let's go through Q&A. Again, if you want these slides here, I got time. We only got about 3 minutes here. I got time for a handful of questions. I do see some in the Q&A box. If you have a question, please feel free to drop it in the Q&A box. So quick question. I'll start with this first one. What type of investments is Headway looking for today? Great question. So we are looking for exactly what I talked about. We are looking for one, distressed multifamily real estate, if possible. We'd love to find something that is distressed, meaning we can likely buy it, hopefully for a discount or for a really good price. That's really on the top of our list. The second thing we're looking for is any type of multifamily asset that cash flows. It doesn't necessarily have to be distressed. That would be ideal. But if it cash flows year one, I mean, it doesn't really matter if it's distressed as long as it has a value add play. So we are looking for value add opportunities in 2024. That is what's really most important to us. We want to get that cash flow year one. Next question on here. Let's see, there's a few. Let me try to pick a good one. What type of cash flow is good for year one in a distressed opportunity? Oh, that's a good question. For me personally, I like to see at least 5 or 6% year one, especially in today's market. If it's a value add play, anything less than 5 or 6%, I'm okay with looking at 4+. But really, for me, I really want to see 5 or 6% year one, and then annualized, I want to see much higher than that. I want to see 7 or 8% sort of annualized. But I understand that year one, you're getting rid of bad tenants. You're improving operations. You are doing renovations, granite countertops, flooring, things like that. So I know it's gonna be a little softer year one when you're doing a lot of construction. You're gonna have a little bit higher vacancy. It's gonna be a little harder to push rents until your units are renovated. But if I can see 5 or 6% year one, I'm good. But I typically want to see a 7 or 8% throughout the life cycle of the deal on average. I own a bunch of single family homes. Do you think rent will slow in this asset class too? Great question. I'm not as active on the residential space, but I will tell you, I do see a lot of inventory online on the residential space here in Houston, at least. I do know a lot of realtor friends. I have had some friends that I know that have rented homes, and there's a lot of inventory on the market on the residential side. So it's really hard for me to say if rents will slow in that asset class too. I think they will do the same thing and kind of flatline. I don't think necessarily they'll aggressively drop. Maybe you're looking at a 25 to $50 decrease compared to maybe what you thought you were going to get. But I don't see a massive decrease in residential real estate. I'm sorry, yeah, residential real estate rental prices, but I could be totally wrong. So that is a great question. This is why I try to focus on multifamily, a little bit different beast. Let's see what else we got in here. I am looking for cash flow and prefer not to invest in 3 to 5 year deals. Tell me more about the income fund. So, John, just reach out to me about the income fund. I'll take that conversation offline. If you don't want your money locked up for 3 to 5 years, the income fund is a great opportunity. It does have a liquidity component. You can pull your money out in 90 days or less. If there is a lot of pent up capital, as your slide showed, how will you compete with these large funds? So somebody's talking about the slide. I'll go back real quick about the dry capital on the sidelines. So they're asking how we will compete if there's a lot of dry powder on the sidelines. That's a great question. The key here is one, having local relationships. So a lot of this pent up dry capital, this institutional capital, these big funds, it's like turning the Titanic, is how I like to describe it. They can make moves, but they make moves very slowly. There's a board, there's a committee, there's a lot of investment decisions. Now, while we have a great team here at Headway, we're very nimble, right? We talked about being strategic and purposeful here. We don't have the same organizational process where we have to go and vote on it and wait 6 months before we can start making investments. If we like what we see and we find a great deal, we're all ready to jump on it, right? So we're nimble. That allows us to move quickly. So that should allow us to buy some deals before a lot of these funds jump back into the market. So in my opinion, there could be an opportunity, maybe 6 to 12 months, probably it's less than 12, but definitely around 3 to 6 months, where the institutional capital that has all this dry powder is not yet back in the market. They're still going through the committee process, deciding if they want to jump back in. And that 3 to 6 month window where they're ready to get back in, but they're not quite approved to get back in yet, we could be jumping back into the market. We could be buying deals, right? So we could pick up 1 to 2 deals before all the institutional capital decides to jump back in and create a little bit more competition in the market. It doesn't mean that once they're back in, things are bad. Not at all. It just means it's a little bit more competitive, right? Instead of us just being sort of the local owner operator looking to buy, you got some players in the bids when you're making an offer on these deals that are a little bit bigger, right? Doesn't mean we can't win. We have great relationships with our local brokers. All the brokers we work with live in Houston. They know us. We go to lunch with them. We go to dinner with them. We have great relationships with them. And that plays a big role in winning deals as well. Of course, institutional capital is great and they have a lot of money and they can buy things cash. But a lot of times relationships also come in play. And a lot of times the sellers also like to sell to other groups that they know and they have a relationship with as well. So that is how we plan on competing in 2024, even if some of these bigger groups decide to jump in. So we're right past the hour mark here, so I don't want to hold up anybody's time. It is, it is time to cut it for today. So real quick, I just want to say thank you to everyone for joining our webinar today. We do these weekly across every month, so every week. Typically on Thursdays, we invite you to join us for our next webinar. If you have any questions, reach out to me, Brian at headwaycapital.us, or you can reach out to our team at investor@headwaycapital.us. And I look forward to seeing everyone at the next webinar. I want to say thanks to everyone for attending, and I hope everyone has a great 2024.